Cool. So welcome back to the 1%. Thanks for joining us today, whether it's on YouTube or the different podcast platforms. Today we've got like a really cool guest who's joining Rory and I. His name is Justin. He is a business science graduate from UCT who specialized in investment and is now doing his accounting articles. So he's come on the podcast to join us and just to, I guess, help us and guide us through this conversation where we're going to be talking about investing. So yeah, Justin, thanks so much for joining us.
Pleasure. Yeah, thanks so much for having me.
Yeah, 100%. So I wanted to start off by just chatting a bit about personal finance, maybe getting some tips from you guys just on personal finance. Maybe I'll start with you, Rory. Like, do you have any advice that you would have given to yourself, maybe at like age 16, 17, 18, on personal finance and managing your money? What would your advice be?
I think first and foremost, just don't buy dumb shit. I think that's the top of the list there. But you know what? I think, and I'm didn't get a chance to say it, but thanks so much to Justin for coming on. It's so nice to have someone who we can bounce these ideas off, right? And I'm in the same boat as you, Gid. We've started off with not a background in finance, but kind of working our way up and learning as we go. So I'd say the best advice I'd give to myself at that age is just learn. Learn the basics, learn the fundamentals. Don't look for the quick fixes and the get rich quick schemes. Just really build a fundamental understanding of how money works and the psychology behind money too, the mindset that you need to have going into it. So yeah, I think that would be the foundational place that I would start.
So like talking about some of those fundamentals and stuff, maybe over to you, Justin, like what would you say, I guess, are your fundamentals, like your principles of managing your own money that you would pass on to someone else?
So, just to be a bit controversial and almost go against what Rory was saying is that I actually think to make some of those mistakes, like spending mistakes early on in your life isn't a bad thing. So you try to be a bit materialistic or whatever, and you buy something and you realize that that's not really going to give you any gratitude or gratification, so to speak. So once you learn that quickly, you realize what is your goal when you do start investing or start saving, per se, and you realize that if I from as you say, from a young age, like 18, 19, 20, we want to give ourselves this advice is start putting money away. You're putting money away because you want to have a happy life with your family, go on holidays together, vacations, have a nice house, schooling, education, those important things. So I think once you realize that should be your goal with investing and saving and working towards, I think it becomes quite a important building block. I know we get caught up in kind of social media lifestyle, keeping up with the Joneses, so to speak. So I think once you realize that, maybe that guy next to you who's wearing the latest pair of shoes or the nicest watch, maybe he's not actually as cool as he thinks he is.
Mm-hmm.
Kind of what I would say about it.
Yeah, and I like your point about sometimes you have to go through those things first to actually learn them while you're young. But have you always been pretty good at saving and putting away money? Like you just said, putting away money for your family. I don't know about you or you, Rory, but I definitely wasn't thinking about my family and stuff previously. When I was 19, 20, 21, I was just living month to month, spending on in gym memberships, protein supplements. I had no idea about thinking long term and stuff. So have you always been good at saving and thinking long term?
Yeah, it's not necessarily. I haven't always been good at it. As I said, I've made these mistakes and I've gone through cycles. So there was there's been stages where I just came out of school and I actually managed to get a contract with Western Province for rugby, and I started getting a bit of money, and I was disciplined enough, put that away, and I realized make essentially your money work for you in the long term, and then varsity came about and I was it'll be quite cool just to spend a bit of money here and there. So I made those mistakes. I can't say I always had that bigger picture thinking, but then with having made those small mistakes, I ironed out those kind of kinks and realized that, I speak about saving up for family, but I am getting close to that age now where you got to start thinking about, what is important in life. And you don't want to sit around and not be able to essentially provide a really nice quality of life for your family or whatever your goals are, whether it be if that's not what your idea of happiness is, then maybe you want to travel the world and you're going to have to need money to do that. So I think I've not always had that bigger picture thinking, but I think making those mistakes early on and realizing what was important from an early age was kind of what set me on that path, I'd say.
100%. Yeah. And on your side, Rory, like, I guess, like, what are some of the lessons you've learned, like, from, you know, the last 4 years, you know, going from 21 up to now we're at like 25, 26. What are some of the key things you've learned?
Yeah, well, firstly, I think that's such a great point that Justin made, and I actually agree with that. You know, that sometimes you need to make those mistakes. You know, a lot of the time you need to make those mistakes, and you know, rather have it happen, you know, now or when you're a little bit younger than later on. You know, we've got time on our side, and you know, in most cases, you know, at this age, you're not at your financial peak, so rather make those mistakes now. But yeah, look, I think between 21 and 25, it wasn't really. I've always been really good with saving money, but not very good with the investment of that money, if that makes sense. And again, this comes down to what Justin was saying about your idea of happiness and gratitude, you know, and this way I think it comes to your values, because whatever your values are, those are what's going to determine how you spend your money. So for example, when I was 21 and I was earning some money, you know, for me to go spend that on chicken breasts and supplements was perfectly fine, right? That brought me happiness because that was my primary value. That's what I cared about at that stage. But as Justin says, you know, as you grow, as you get older, your values start to shift. Your idea of what happiness and success is starts to shift. And I think for me, the biggest shift has been that, you know, just changing my targets, understanding what I want for the future. That's what really got me started on the years of actually taking money seriously. So I've never really been one to waste money, but really actually thinking, how do I want to save money? How do I want to invest it? And what is my actual purpose behind it? So I think just that fundamental understanding, that has been the shift for me. It's those shift in values.
100%. And so obviously, like, I got a chance to work with Warren Ingram, who's like quite a well-known sort of financial planner and author in South Africa. And just like listening to the content that they say while I was editing it, they were saying a lot about like these 3 steps and to achieving financial freedom over a long-term sort of plan. And the 3 steps are quite simple. It's like you start off by getting out of debt. That's the most important thing. Like, debt will eat up your money faster than you'll make money off any investments and stuff. So especially like short-term debt, like credit cards, like clothing accounts, these type of debts that like is usually quite common for younger people. So get out of debt as soon as you can. That's the first step. The second step is to build up like an emergency fund. So that's to like look at your monthly expenses and be like, okay, whatever it is, like let's say I'm living off 25 grand a month, then you multiply that out by 3 or 4 months and you try to save that up. So that if your car breaks down, if you need to replace like your stove, or if any like shit happens, you can take money from that emergency fund and cover it. Like, you don't have to take out a loan to cover up these random expenses.
Yeah.
So out of debt, build up an emergency fund. And then the third one, and the one that I want to really chat about with you guys now, is like then building up an investment portfolio. So once you've paid off your debts, you're debt free, you've now built up an emergency fund that's topped up, and now you've still got extra savings. Once you've done that, where do you put that and what do you look into? Justin, we were chatting a little bit before this about easy equities, ETFs, individual stocks. What would your thinking be in terms of building like a portfolio that you could live off one day?
Yeah, so just touching on what Rory said, is that he's been good with the saving side of things, but the investing side's a bit harder. And I think a lot of people like kind of have that issue where they view, you know, investing as like a scary or like foreign kind of like fields. But I think that investing has become quite simple, and it's you know, and I say that like because I pay respect to a lot of people that like paved the way, that they've made it like retail investors kind of able to act in the market as easily as like any asset manager. So just speaking as you mentioned, like an easy equities account, if you know, there's things like index funds or ETFs that kind of track the market, and the one that's often mentioned is like the S&P 500, which is obviously, as people know, like the 500 biggest companies in the US, which is, you know, quite a good indicator of like the US economy. So yeah, if you put like an X amount of money in the S&P 500 a month, or whatever the case is, if you have a lump sum, like the general performance of the S&P 500 has been, you know, over like a historical performance has been like 10% per year, which is pretty decent. And obviously there's been years like recently where the US has been in a huge bull run, which has returned a lot more. So I think, like in terms of once you've got that emergency fund built up, you have the opportunity to invest, then you should start looking at some of these ETFs, because yeah, I mean, investing is difficult at the best of times in the sense of when you start to pick stocks and that type of thing. That's where it starts to get a bit messy because I'm not sure, if they'll even release data on it. But if you had to look at like some of the big asset managers, I think, they haven't been performing well because they're active investors and they have to try, and pick a few stocks and make their whole share portfolio up for their clients. Whereas if you, as you said, like a retail investor, someone who's every man like on the street, and you just decide to put into an ETF, there's a variety of ones. Like a top 40 would be the African one, which is obviously the top 40 companies. But a much safer bet would be to bet on essentially the US economy and stick some money in. So I think that would be quite a good starting point if you do have a bit of money, or like something like the MSCI World, which tracks basically, it's 64% of it is made up of the S&P 500, and then the rest is with like emerging markets, China, Asia, South Africa is a small, like 1% of that index. But yeah, so that's a very good starting point, I'd say. Yeah, Rory, would you agree with me on that?
100%, man. And like, to be honest, like everything you say now, it's so good to have feedback from someone, who's a professional in the field, because that's kind of where I started as well. Like you said, you hit the nail on the head. Savings was cool, but to get into investing was now this, this whole process. So like I took courses on it and, trying to figure out how to pick stocks and, how to get this all right. And I was thinking about it, and reading other people's results. And I was like, the chances of me of studying for 2 months, picking a winning stock, it's basically zero, right? And I read a book recently. I don't know if you've heard of it. It's called Unshakable by Tony Robbins. And in that book, he is so big on that. And it's all about the index funds. And he says, again, I don't know how accurate it is, but 98% of the active fund managers are not returning as much as your index fund. So we're overpaying because we're paying now fees for the active managers, but we're not getting the same return. So like you say, you invest in a low cost index fund, you're getting charged maybe 0.5%, and you're getting your 10%, which is, when you compound it, so vital. So man, it's actually so good to hear that reaffirmed. So thank you for that. And yeah, so I think it's the best place to go. Look, and I'm sure we'll talk about it more. There's lots of other avenues, and picking stocks is something I'd like to do in my future. But I'd say as a foundational element, that's definitely where my focus is as well. It's just getting in the money into the index funds, putting it away consistently, and kind of building that up. And I agree completely with using the US stock market, because what's also quite nice, I don't know if it's told you, a lot of my clients are international. So I've got the benefit of, getting paid in dollars, waiting on the exchange rate, and then bringing it over. So I feel like that added benefit is also there, so you can kind of time that one too. Growth. So yes, exactly. Right. Exactly. And, when there's things going on here and whatnot in the economy, at least over there, generally it's more stable. I don't know. That's just a thumb suck, but I just feel safer, if that makes sense. I feel safer having more money there in the dollar, getting that index fund. And so, yeah, man, to be honest, I've actually got nothing to add. You literally affirmed everything I was going to say. So thank you.
Just to add a quick proviso there before I get roasted by my friends. So I'm not a professional in investing, whatever. Just so I studied the business science, finance with accounting, so it's like a double major. So so my one of my majors was finance, not necessarily completely focused in investing. So just before people come down on me and say, what claims are these?
Nah, I hear you, man. That's perfect. But thank you for sharing the knowledge anyway. It's just so good to bounce these kind of ideas about people who are involved.
Completely agree with exactly what you're saying. It seems like we're definitely on the same wavelength with that.
No, and it's good to get that information. What do you think about that, Gid, like in terms of like looking at the US stock market as well and actually investing internationally?
Yeah, so it's actually cool that book, Unshakable, because that's also where I read that stat where it was like most active fund managers or whatever it is, they don't actually outperform the market itself. But I think the key thing there is over a long period of time. So like they might have incredible years where they beat the average return of the market. So what Justin said, the S&P 500. But over like a 10-year period, a 15-year period, the chances of them actually beating the market itself is very low, and money is getting by fees. So I think that also relates to what Justin was saying of how easy it is these days for someone like the average person who didn't study finance. You just go and download an app like Easy Equities here, or I guess in the States they have like Robinhood, that kind of thing. The average person is very much easier to get educated on it and to buy these indexes. One of the things that I think that's quite interesting. So you brought up the JSE top 40. So a lot of people think that like investing in the JSE Top 40 is the same as investing in South Africa's economy. But I think there is a bit of a difference there, because a lot of the companies that operate in South Africa, the big companies like Naspers, these huge conglomerates, they actually earn a lot of money overseas. So like someone like Naspers is listed on the JSE, but they own, a big portion in a company like Tencent, which is heavily involved in China. So you can still you can still invest in JSE Top 40 companies, even if South Africa's economy is getting a little bit hammered or it's not growing. Doesn't mean that your companies in the JSE can't grow. And it's kind of the same with the S&P 500. Like a lot of the companies there, even if the US economy is taking a bit of strain, like those companies are like Facebook, Google, Tesla, they operate globally. So if you are looking at like individual stocks, you want to try to find stocks and companies that are growing really quickly, I guess.
Yeah, no, that's awesome. That's a good point about the JSE as well. I didn't think about it in that light.
Yeah, I think the thing about sorry to interrupt you there with the JSE Top 40 is that like I'm not sure what the exact percentage will be now, but I know like 1 or 2 years ago Naspers was making up like 15% of the weighting of that JSE Top 40 index. So I mean like that the performance was kind of like reliant in a big way on Naspers' performance. So yeah, and Naspers has been performing so well over the years. So essentially like that's kind of carried. I mean, the South African market has been relatively flat this year. It's actually been performing quite well, but it's been relatively flat over like the past 5 years. And if it wasn't for Naspers, it would have been like deeply in the red. So yeah, so that is the one thing that like you have when you do look at investing, you must also try to look at like, for example, like concentration of certain companies. So like in the S&P 500 index, because there's 500 companies, I think Facebook and Amazon and Alphabet, whatever, will make up like 1 or 2% of the index, which is that's fine. Then if Facebook drops by quite a lot, you're still spreading out your risk quite a lot. But like as I was saying, a company like Naspers, which is 15% of an index, then Naspers does quite bad, does badly, then the whole index will be pulled down. So yeah, that's just like one thing to look at when you do invest in South Africa, is like go look at a fact sheet and see how much they'll show you the top 10 holdings in the fund, and you can just see, okay, cool, like if I invest in, as I said, like the S&P 500 will show that the top 10 holdings are Facebook, Amazon, Alphabet, whatever, and they'll show like, okay, Facebook's weighted 2% of the index, Amazon's like 1%, whatever, and then as I said, you can go look at like the JSE Top 40, and then you'll see, okay, Naspers is however like what its weighting is. So that's like one thing to just look at, that like managing your risk when you do invest in these index funds.
And if I take it like kind of high level to someone who's maybe listening and they're like, what is the point of investing? Like I can rather just save my money and I've built up a savings account. Like maybe they don't understand, like how inflation works and how savings doesn't really, like your money gets eaten away by inflation over time. How would you explain like the sort of overall concept of investing, like putting your money in a company so you can grow somewhere else over time? Like how would you explain that?
Yeah, so I mean, it's basically like the fact is that when you put the money in a savings account, you get the sense of like surety that, okay, you'll get whatever percentage is, it'll probably be like 5-6%, even if that, a year, which I mean, after inflation is not no real return essentially. So your money isn't growing. Whereas if you invest in shares or stocks, whatever. Historically, obviously, the equity market has returned, because there's a risk element to it, has returned a higher return than saving your money and investing in a bank. So that extra return you'll get, obviously, then equates to being a real return. So your money grows over time, and so what you have in a year's time, including the inflation, you'll still have made money on that. So that's essentially like the reason why people would want to invest as opposed to just save. But then that's as like a disclaimer in any financial podcast, is like historical data isn't an indication of like future performance. So there are people that are extremely risk averse who then will say, what, if especially it's a lot about like your makeup. If you're a pensioner and you have your money in the bank and you're earning your 5%, that's fine. It's a low amount, but it's fine because it's what you need every month, and you're not working, you're sitting at home, whatever the case is. But if you're a youngster and you or whatever the makeup is, or middle age and you're like, okay, I want to actually just make a little bit of money, and you put it away in shares, then you are going to get a higher return, hopefully, or whatever.
And like Rory, from your side, like maybe you can speak on like how important it is to, because I guess like when you're younger, like you kind of like, well, I'll do this one day, I'll do this when I get to 30, I'll open my investment accounts and stuff. But maybe speaking on like a sort of a habits perspective, like why is it important to try to at least learn while you're young and try to create the habits of investing and saving while you're younger? Like how does that play out over time?
Well, I think it's the same concept as every other area in life, right? The compound effect, we obviously know about it in finance. So obviously, again, for anyone who's, just a global view of finance, that compound effect, you put 10 Rand away, you're getting 10% on 10 Rand, and then you're getting 10% on 110 Rand, if my maths is good, but you get the point, right? So it's that compound effect. So the sooner you start, the better. The same goes with your fitness, the same goes with your mindset, the same goes with your relationships. It's that daily deposit almost. You're consistently putting that amount in, and it's not the amount that you add in that's stacking up, it's the interest and the compound on top of that. So again, I read this study and I can't remember the exact figures, but there is a massive difference. I mean, if you just start investing, even a year, 2, 3 years earlier, the effect that has on your retirement lump sum at the end is astronomical. So, starting earlier, getting that compound effect in, and just building the habits of putting money away to invest. I think that's one of the most important things. I think it's the foundation. So the way I did it, and I think this is what really served me well, is something so small, right? When I first got my first bank account, I set up a savings account and I put a debit order on for, I think, 200 Rand or whatever it was. And that debit order goes off every single month still to this day. And I think when you get into the habit of that, you learn to live within the finances that you have, right? And I read this somewhere as well. The people that are wealthy, the people that become financially successful, they invest first, then they pay their expenses, and then they go on to buy the things that they want. So I think building the mindset and the habit of making sure that your investments come first is crucial. And I mean, obviously that's going to look very different at whatever age of life you're at. Like Justin was saying, right, that's very, very dependent on your age. If you are 21 and you live at home and you've got no expenses and you're making an income, then, 15, 20%, try to put it away. But it's a very different story if you're approaching retirement and, you don't have that many funds. But I think from a foundational level, it's building the habits, and that habit is going to compound. It's the same thing, right? You work out once a week, you're going to get a certain result. You do it 3 times a week, it's going to be way bigger. You start a year earlier, and it's really going to serve you in the long run. So I think just consistency, discipline, and just learning to live within the money you have left instead of trying to invest the money you have left, if that makes sense.
Yeah, 100%. Like I actually heard this thing that Warren said once when he's like, he knows a lot of people who earn crazy high income, but they're not wealthy because their expenses are just as high.
Yes.
So they never save any of it. It never
Exactly.
It's like it just comes in and goes out, and they live this cool lifestyle, but they have no real like wealth to lean back on. And when I heard that, I was like, that's quite crazy. Like if you don't like nip it in the bud while you're younger as well, like can you imagine how hard it's going to be when you?
I think a prime example of that is if you look at professional sportsmen, especially like Americans, like whether it be basketball or NFL or whatever the case is, American football. Like those guys earn crazy salaries, and then they get caught up in that lifestyle, and the expenses, follow their lifestyle, and as much as they earn, they want to spend, and then the careers are obviously limited, and then afterwards becomes a financial disaster. So
yeah, kind of like Mike Tyson as well. Hey, like he was one of the ones who earned like a huge amount of money, and then like eventually ran out of everything. Like.
Yes, 100%. And I think, just to add in there, because I think it's so important, because what you said now is the most important thing. And it's one of the things that I'm so grateful I learned from my parents. And again, like something like this, for example, for me personally, came naturally because my parents taught it to me. But, we don't get taught this stuff in school. And, if you grow up in a family who don't have that knowledge, you're not going to get it. And that's that making money and becoming wealthy are 2 very different skills. Right there, you can make, like you said, you can make a lot of money. And I know people that make a hell of a lot of money, but there's never money left at the end of the month, right? And that net worth isn't increasing. So managing money and investing is a whole different skill. I feel like people get caught in the trap of thinking that if they earn a lot of money, that they can earn their way to financial freedom, which obviously is a factor, but it's building those things up in the long term and investing that money that counts, right? It's the same thing as, you can come and you can exercise for 8 hours today and you can push yourself harder than anyone for 8 hours of today. But if you don't do anything for the rest of the year, it's not really going to make a difference, right? You're not going to get fitter. And it's the same thing here, right? These people, like Justin said, these sportsmen from America, you see it with these rappers all the time as well. And I think what happens is once you start living a lifestyle, it's very hard to regress, right? Like it's very, very hard, to take a look at your lifestyle and say, look, I need a downsize. But I mean, if you just stay at a level that you're happy with and invest upwards and then wait to kind of take your step up, that's much easier. Stepping back is always way harder than stepping up. So I don't know if from either of your guys' side, I mean, if you know, or if you've had these struggles with yourself. I know I've seen a lot of people that go through it, but I mean, what is the biggest financial struggles that you guys see?
Yeah, so I think like the biggest thing that I see, and it's ubiquitous. It happens, like we see it everywhere, is that people are very focused on lifestyle and not so much on their future wealth, like generating kind of like a sustainable lifestyle. So, as soon as they start earning like their first salary, then they want to, get a car on finance. They want to, start mortgaging a house. They want all these things, and they essentially get caught in that debt cycle or that trap where, you're a hamster on the wheel and you forever, you're looking for that next pay increase or, whatever it is, and kind of like what you say, where people think they can earn themselves out of the situation or whatever the case is. I think that's a very dangerous trap to get into. We see it with so many people where if they can't stop working for a month, or if the expenses you have to see the expenses, it would add up astronomically. So I think those bad money habits of trying to take things buy cars on finance, buy house, mortgage houses are too expensive, and then credit cards, things like that, where you're starting to kind of over leverage your lifestyle. It becomes very dangerous and it becomes like a trap, and it's extremely hard once you start to ever get out of that. So I think as you said, from an early age where you maybe don't have as many expenses and you learn those money habits that you don't need the latest car, you don't need the latest gadget, whatever the case is, and you start putting that money away, investing and things like that, then you'll set yourself up for, it's that's an easy way to set yourself up for success in the future. And it's essentially as much as I don't want to say this word, it's foolproof in a sense, but start developing bad money habits and you're going to have a very stressful and difficult career ahead of you.
Yeah, straight.
I guess the next thing I wanted to bring up, and I guess this is the kind of the crazy exciting part of this discussion, is talking about cryptocurrency, Dogecoin, Reddit, GameStop, stonks. Maybe I'll start this by saying, Rory, you actually messaged me about Bitcoin the other day, and you were saying you should put a bit of money into Bitcoin. And I'm not going to lie to you. At the time, I was I have got savings, but I'm kind of keeping in the business for things that I need to cover. And then Bitcoin just went on a tear, bro. And I just saw it literally went crazy. And I was actually thinking it would have been cool if I'd actually bought some. So maybe you start off already just by saying what your experience is with buying some Bitcoin. Maybe you share some honest feedback. And then after that, Justin, you can add your Bitcoin.
Yeah, man, it's perfect that I'm going before Justin because I need to hear what he has to say. So when it comes to Bitcoin, right, Bitcoin is one of those friends, that was cool to me sometimes and they're not so cool the other times, right? But what happens with Bitcoin, right? So to be honest, Bitcoin was my first investment, right? The first time I invested, second really, I put money into a fixed deposit. I was earning, I think, 6.5%, 7%. And then a friend of mine came along and said, hey, listen, why don't you buy some Bitcoin, right? So first off, I think Bitcoin is great, right? Personally, again, not from a professional point of view, but I think, it's going to grow in the future. So holding and owning Bitcoin is such an awesome thing, right? Because I think long-term, it's going to be growing. So I've kind of shifted my approach. When I got into Bitcoin, I was looking for quick money, right? Like we were saying earlier, I didn't have those fundamentals in place. I was okay, this thing is going up. I want to make a quick amount of cash and I want to pull out. So since then, I think I've changed my approach to look at it as more of a value kind of growth, right? So that it's going to actually, it's more of an investment I want to leave for a couple of years and, watch what it does. But one very important thing about that, and as I'm happy you brought this up, is that greed can hit you very quickly and very easily. I've never considered myself a greedy person. I don't consider myself a greedy person. But when it came to investing in Bitcoin and a couple of those schemes, I got greedy and I got bitten really, really hard. So it's something I want to share because I think it's really important, right? So anyways, having that Bitcoin, the price was going up and it was continuing to move up. Then I kind of got this company who said, listen, we invest your Bitcoin for you. And not only do you get the growth of Bitcoin, but you also get the return we give you from trading with it, right? So this company seems super legit. Everything was great. I don't know if you've heard of it. It's Mirror Trading International. Cool to put it out there, a bunch of twats. And anyway, what happened was this guy, fully great setup, everything was good, very professional. And essentially this guy ended up buggering off with 23,000 Bitcoin. So the story from that and the lesson I really want to get across there is that all these things are great and it's good to find things with good returns, but greed can hit you when you don't even know that that's what it is. I mean, I didn't think I was greedy. I thought I was just making a good call. But the expectation of getting 10% a month every month on top of a growing Bitcoin is just unrealistic. So when it comes to that, like Justin was saying at the beginning of the session, rather learn these lessons young. So I would rather lose the amount of money I lost now than wait 15 years and then lose it then. So yeah, when it comes to Bitcoin, I think it's great. I think it's a long-term hold as opposed to a short-term gain. And just buy Bitcoin, keep it to yourself and don't invest it with any of those schemes. So that is my take and my experience on the Bitcoin.
Interesting.
What are your thoughts that side, Justin, on Bitcoin? Do you own any Bitcoin? Has anyone tried to convince you to buy some? What are your thoughts?
No, so actually, I don't own any Bitcoin, but I do have exposure to cryptos in the sense of that there's that crypto kind of ETF that it was called the DCX. I think it's ECX now 10, which is on Easy Equities. But just with regards to Bitcoin and cryptocurrencies, is I think that there's enough talk and hype about it that people know now that cryptocurrency and blockchain, all of that technology is essentially kind of what, when the internet just came about, people were so skeptical and so against it and they were slow to adapt, and there were winners that were, the early adapters. And I think, our generation is thinking that Bitcoin and blockchain and the cryptos are in that kind of category. And I think that I fully agree with you, Rory, in the long-term view with Bitcoin, definitely. But the one thing that worries me is that I personally I'm a long-term investor when it comes to things, and you get traders who trade in stocks or whatever. And I think a lot of the attraction to Bitcoin has been people that are essentially that trader's mindset where you want to make a quick buck. If you're investing money, you want to make it. You're looking to get your return in a month, 2 weeks, a month, whatever. Get in, get out, that type of thing. So I think that's a bit that's where I get a bit worried, because if the people that buy Bitcoin, are you saying, okay, cool, it's $20,000 now. Once it gets to $60,000, maybe I'll take some off the table, or if it goes down to 15,000, I'll look at exiting my position. That's what people who are investing in should be thinking. These are conversations or thoughts you need to have. And I know that people who are in Bitcoin aren't saying if it goes up. They just there's that hype train and that FOMO hysteria, those stonks only go up. That type of kind of mania that drives the price up. And that's why I'm a bit hesitant to get involved directly, because I know then that's where people get burned. And so I definitely do believe in Bitcoin and cryptos in the long run. I think they definitely, they're here to stay, and they're going to essentially shape the future in a lot of ways, whether it be, for payments or decentralizing kind of, banks' power, whatever the case is. But I do think that there's a big argument for them. But yeah, just in terms of investing, it's difficult to have an opinion when there's so much hysteria and mania around Bitcoin and stuff like that.
Yeah.
Yeah, I agree with both of you guys on that long-term thing. Like I mean, like if you look forward into the future, like it obviously makes sense that something like it, or either it or something like it will exist, and it has a, you know, a clear place in society. But it's just hard to know, like if Bitcoin would be the one, or if another one's going to come up. Like if you look at like Dogecoin, which is like a meme coin, right, basically, and then it just gets pushed by the right people on the right social platforms, and then it takes off. Like who's to say that something like that? Who's to say that something like that? Or a coin like that is not going to take over and then become like the currency. Like it's just hard to know which one is going to be the one long term. So I guess like another thing to do is just to like not put all of your money into one thing like that. Like just try to like
Definitely
spread it out a bit. Do what Justin says, buy the ETFs and the stuff that, you know, track a whole market or a whole basket of stocks. Keep a bit of money in savings as well, and then take a bit of like bit of your fun money, and then buy like individual stocks, buy cryptocurrencies, and then have your hype on that. Like check the share price every day, 5 times a day. Tell your friends about it. Like just make sure you don't put all your cash into that, I guess.
No, I think that's and the way you said that, to be honest, I don't know what Justin thinks, but I mean, that is exactly how I kind of look at my portfolio and my allocation of funds. I want that exact same structure. You know, you want the stuff that's, for example, even something like a fixed deposit. You know, I mean, yes, you're not going to get the greatest returns on it, but I think it serves a purpose, and it serves a place in your portfolio. You know, having one there that's your kind of safety net, your one that's kind of, you know, just in the background, not your flashy one, just the solid workhorse, right? That's just going to get things done without any risk. Doing your stocks, having your crypto, and then, you know, having that money where you have a bit of fun with it. You know, 5%, 2%, whatever you're willing to give, and, you know, bet on it. And again, not gambling, not trading with it, but taking those higher risks. So I hear a lot of people talking about, you know, are they moderately aggressive or conservative? And personally, I think we need to have like a pretty fair balance over that range, you know, again, depending on your circumstances and your tolerance. But I think we need to play in all of those areas. I think what's going to differ is how much concentration we put in based on what we're personally willing to risk. So I like that you brought that up. Justin, what do you think about like your balance of the portfolio?
You know, so as you say, I think it does differ depending on who you are, but I definitely think it's important to to have some either money in savings or a fixed deposit or whatever, because a lot of times opportunities do arise. So, you know, if for an example the stock market crashes, you know, the people get into hysteria and want to sell and things like that. But if you're a rational investor, you're thinking of it like, okay, cool, this is like going to the shops and seeing something's on sale. So now instead of like buying it at its peak at most expensive, you're getting it at a discount. Then now you can start allocating a bit of your funds back into the shares at half the price, whatever the case is, and things like that. So with regards to like the balance of a portfolio, I think it's quite difficult to give an exact answer. But I think that like depending on you should just try. I'm a bit more risk averse, so I almost want to put like 60% of my money in equities, and then I'll keep, maybe 20% in kind of bonds or fixed income, and then you get 20%, which is just like something to like wiggle around with, and for opportunities and like kind of like savings accounts, like liquid money, kind of cash, so to speak. So I don't know. That's not a great answer, but I think it does depend on kind of like your like preference for risk and like opportunity and what you think you're going to make the best use out of that money with.
Exactly. Like you said, it fully depends on your situation, right? And I know what you mean. That's why it's a challenging answer, because you can only take it from a personal point of view, right? And from the view of whoever's actually doing the investing. And I like what you said about, going into the shops and seeing that. Tony Robbins had a great quote on that as well. He said, if you go into the shop and you want to buy a Porsche and it's $200,000, you go back tomorrow, it's $150,000 and you don't buy it, you're an idiot. So looking at that long-term growth, I think that is such an important one. And I know I don't want to get out of the scope of what we're doing. There's so much to chat about, but that I believe is very important as well. And it kind of links to what you were saying about this, this hysteria, like Ed was saying about, this whole Reddit thing, the crypto, all these hysterical things. I feel like it goes the other way as well, right? People get into the stock market, for example, like you say, it crashes, they freak out, they pull out at a loss. But if you look at at the history of it, especially talking about America, in the S&P 500, for example, it always corrects. The market always comes back up eventually. But it's the people who buy high and then sell low because of that hysteria. I think that hits people really, really hard.
Yeah, that's such a good point. Like just being able to control your own reactions so you don't buy into the hype, because it's getting harder and harder. Like these days, the social media and stuff, like you can't go on Instagram or Facebook, whatever it is, and not see like all the hype about, GameStop and Reddit and Dogecoin and Bitcoin and stuff. So it's getting harder and harder. And then the thing is, like, it creates this mass movement where everyone buys into something and then the share price does grow. So they're not wrong. Like the actual stock or the price of the coin, spikes. But I'd be very curious to know like what the super like experienced investors and like level-headed like hedge fund managers, what they've been doing over the last like year or 2 years when all these other stuff have been crazy.
Must be hating what's going on at the moment.
Yeah, I'd be curious to know like what they're doing and how they're making money off of it, and like what moves they're making. Like these guys have obviously got like years and years of experience. So they're probably like benefiting off everyone's like hysteria, or maybe they're getting squashed like because they're short GameStop and then GameStop and then it like shoots up. I'd be curious to know what's happening behind the scenes.
So
yeah, it's interesting. I think like with like those investment professionals, I'm sure they might have a completely different philosophy. But for me, with like a lot of these things, I think that if you miss out on like the GameStop rising 400% in a day, or you miss out on like Bitcoin's rally of 20%, like that's where people start making stupid mistakes and becoming greedy, because you think like, oh, I've missed out on this opportunity. Like I have to get on the next one, and I have to get on the next one, whatever the case is. And you start becoming like impatient. And then like you suddenly try, irrationally just throw some money at like the problem, and, then you get burned. So I think like with the hysteria, I think it's equally as important to like cancel that noise. Like maybe you miss out on the 400% gain or whatever, but it's also important because you miss out as well on losing that 400% the next day or whatever the case is. So like people just need to also like realize that like these opportunities that you miss sometimes, like just because you miss them doesn't mean you should like try to chase the next one. If you miss an opportunity, you must think about like the next one rationally as if that first opportunity kind of wasn't there, because there are always going to be so many opportunities in the market.
Exactly. And I think money is, and I don't know what you think about this, kid, like money is an emotional game. I mean, for so long I tried to, almost think of it non-emotionally, but it is emotional, because like you said, when the hysteria comes, what is it? It's emotion. That's why we do it. We get fearful and we pull out, or we get that FOMO feeling and we jump in. So I think managing your mindset and your emotions around money is absolutely crucial. Like if you can't keep a cool head, like you said, like that's why I'm wondering also how these guys, these big guys are playing it, because if you can't keep a cool head and you also can't contain your excitement, you can end up making decisions that can bite you in the long term. So what do you think about that, Gid, like in terms of like managing your emotions and your state around money?
Yeah, I completely agree that that's what the game is. It's like managing your own fear on one side and greed on the other side. And that'll be different for everyone else. Like other people be more fearful or less fearful than you. So I think you got to have a bit of self-awareness there. And I think like Justin said earlier, like just having a plan. So saying like, I'm going to buy in at 20,000, I'm going to sell out at 60,000, or I'm going to sell half of it at 40,000. Like just having some sort of like strategy that you got to keep to, I think is a good way to go. If you just buy in and you're like going to go as if like one day you're just going to wake up and be like, yeah, today I'm going to sell, or that's like your strategy and stuff, then I think you're probably in for a bit of a shock there. So yeah, I think having a plan and just sticking to the plan kind of, takes emotions out of it, because whatever happens, you got to follow the plan, whether it worked out or it didn't, so. Exactly.
You've got that foundational structure. And I think that's, a big reason why people do get bitten so badly now, because, at the end of the day, we don't get taught this. I mean, I don't know about you guys, but I mean, going to school, I didn't even know, what credit was about. I mean, I thought all credit was bad, so I just avoided it completely. And then you realize, oh, I need credit to buy a house or to get a flipping Wi-Fi installation installed. Like there's so many things. And I think it all just comes down to having a good foundation of baseline habits and knowledge to kind of work with. So I think, like people like you, Justin, getting into the industry, and just educating people about these basic fundamentals is so important, because, we don't get taught it. And if we're not taught it, how are we ever going to learn?
Yeah, I think on Justin's side, like he's not really going into like giving people financial advice. He's not doing personal finance. He's more on the corporate side. So you'd work for like a sort of investment bank and stuff, advising companies with regards to their assets and stuff. But I think like maybe you guys would all agree, like the most important thing at the end of the day is like your own sort of cash flow. Like investing is great and you can be smart with your money and it can grow and stuff. But at the end of the day, like if you don't grow your own cash flow and you don't manage your own expenses and stuff, then I think that's where the real thing is. Like, and the best thing you can do is kind of like, if you own a small business, then try and keep those expenses as low as possible and grow your income. So you have a healthy cash flow. Or if you're going into the corporate world, whatever it is, I guess the same thing. Work as hard as you can to be worth as much as possible to the company, and then keep your expenses like in check. Because if you have cash to play with that's coming in every month, then you can actually grow like an investment portfolio and stuff. But you can't expect to go into a job, have the same job, or grow your business to a certain size and then just leave it there and then live off these investments that are all of a sudden going to take over and feed you. I think at the end of the day, like especially at our age, like you got to try and focus on cash flow.
Yeah, for sure. And those expenses, man, I think that the expenses is the biggest thing. And I think that's almost like step one, right? Like before you, like you said, before you can even think about investing, before you can even, buy a stock, you need the cash to have it. And I think, so many people, and I mean, this is why I think this conversation is so important and to take it on a basic level, because, investing, as Justin said, it's trickier enough, once you have the money to invest. But just helping people get to the point where they can manage their finances well enough so that they have that leftover money to then invest, that's a step before that needs to come. So I think there's a lot of growth and a lot of room for improvement in those areas for everyone, for myself included. And I think that needs to be more of a conversation, saving money, managing money effectively, as opposed to just, making the money in the cash flow, like you said.
Yeah, 100%.
I think Rory, just to jump in there and add on your points. I know you heavily focus on like the mental side of things and mindset, and I think that's actually one of the big things that's missing in kind of like the teachings, even whether it be university. You learn about finance, all those type of things, but people don't really teach you about like the the mindset or the human mentality with regards to handling these emotions. I think that's such an important point. Like if you can't if you can't be rational and you can't handle like the hysteria of things that are going on, like you're going to make all these mistakes. And even just with regards to handling your expenses every month, like you need to get in that mindset of sacrificing a little bit here for like a bigger picture or whatever the case is. Like it all good money habits all boil down to having the right mentality. And I think, as like you've touched on a lot in this podcast, I think like that's something that people don't really look at. People often view these things in isolation. So, people view like personal finance as one sphere and, all this, like all the human emotions about it in a different light. So I think the fact that once you start realizing that like they're so interlinked, I think that's one of like the biggest kind of like lessons you can learn with regards to like personal finance in a sense, or investing, or whatever the case is.
Definitely, man, 100%. And I think it's that combination. I mean, I heard an amazing quote. I heard, success in life boils down to it's 80% psychology and 20% mechanics. And I feel like that balance is so accurate when it comes to anything, right? Because yes, you need the mechanics, right? You need to understand how to invest, how money works, how to pick a stock, how to pick an index fund, right? Those are very important skills. But that foundation of your psychology behind it is everything. Because without that psychology, you can have the best tools in the world, right? You can have the best information and knowledge on stocks. But if you can't manage your own emotions, it's kind of going to be, kind of null and void in a way. So I think this combination and bringing these two spheres together, I think is perfect, man. So I agree with you on that note.
100%. And also like just not being intimidated by it. So I can't remember if it was you or Justin who said in the beginning, but like it can be quite an intimidating thing. Like you hear people talking about stocks and shares and markets and indexes, and if you're not familiar with that, it can be quite intimidating. So like also I had a friend, Steve, who like I would just go to and chat to him on WhatsApp and be like, what about this? What about this? So just finding someone who like knows more about it and just genuinely asking them for advice and stuff. I think that can help a lot with like, getting started at least. And then obviously from there, there's like so much content on YouTube and stuff that you can watch. Like maybe not this one, maybe don't use this exact one as financial advice, but there's good stuff out there.
No, for sure. And I think, Justin was saying earlier, that he's going into the corporate side. And what I was meaning, by, sharing this information, not even in a professional capacity, I think just us as human beings are just growing in all our areas to share this knowledge. Because the thing is that the smallest little piece of advice can make such a big difference. Like a personal story from my side, like when I was talking about the credit, right? Like it's a known thing that you need credits in order to, buy a car or buy a house or these sort of things. I didn't know that for the longest amount of time. Like it's the simplest thing, and anyone could have told me but I didn't know that. So I completely avoided credit cards 110% because I had the mentality of all debt was bad. So that's just an example of something that's so basic and so simple, but absolutely crucial. And I think there's so many little points like that don't get brought up. So, all of us, whether we're, this is our industry or not, I think we need to share this advice. We need to share this knowledge, not in a professional capacity, but just these little fundamentals, because I think if we can all just share this with each other, we'll grow so much. And on a very big kind of euphoric kind of concept, I think that's how we will solve a lot of the money issues our country and the world has, by sharing these pieces of information and building these foundational habits up from the bottom. So yeah, man, I think, doing things like this, doing this podcast and just sharing this information is absolute gold.
Definitely agree with that. So maybe we end off with Justin, and we just say so on that note, what would be some of your tips, your 2 tips for people who are getting into investing? They're not on the same level maybe where you are. What would you share as we close off?
Okay, cool. Thanks, Josh. So just touching slightly on what Rory said, is that I actually completely agree. What I think one of the problems is that people often view money and finance as a bit of a taboo topic. People don't really want to talk about it. It sounds like someone's bragging or whatever. And that kind of drives a lot of this financial illiteracy, because no one ever chats about it. No one tells you, unless it's your parents, and that's kind of there's always going to be transparent conversations. So I think it's a very important thing to try get involved and get these conversations going as much as possible, because you can't just bury your head in the sand and then you're 30 years old and you've got debt. Now you're suddenly oh well, no one told me that this was a problem. But yeah, just to touch back onto Gideon's thing, is that I think obviously, so as you started off saying, is that once you get yourself out of debt, you've got an emergency fund. I think once you're ready as a youngster to start investing, I think a platform like Easy Equities is easy enough. And there's an Easy Equities, you can open up a tax-free savings account, and you can actually invest in ETFs, index funds. So, you get a limit of, I know Warren Ingram will have spoken about this at nauseam, is 36,000 a year. So you put 3,000 Rand away a month. Obviously that's not too hard of a goal. You can get a side job or something along the way and try to get yourself towards this goal. But you put 3,000 Rand away a month, and that will hopefully, grow by 10%, whatever the case is, which is a bit better than putting it away at your bank, but that also isn't a bad option. And then, over time, you put that money away and it accumulates and compounds for you. So I think as a youngster, it's not an unrealistic goal to tell yourself, I can put 3,000 Rand away every month into a tax-free savings account. So that'll be one kind of starting point of advice. And then another thing I would think is that, I know it sounds a bit cliche and to do, but I think just try to develop a curiosity towards, personal finance and investing, because we were taught, obviously I was taught, one of my majors at varsity was finance, but there's a lot of people that were in my classes who, that was their degree. That wasn't what they're interested in. So, they're getting an A for their test, but then in their personal lives, they're not displaying any of these kind of good money habits or knowledge. So I think the only way that you can really develop these kind of habits and success in your personal life is to become quite curious and research the topic, listen to podcasts, listen to Honest Money, listen to The Money Show with Bruce Whitfield. There's great content out there, and it's very easy to learn. It sounds intimidating and difficult, but it's easy to learn. I think just develop a curiosity and you'll be fine.
That's awesome.
Oh, awesome. That's great advice. Thank you so much. Yeah. It's kind of weird how they don't teach us this in school and stuff, but I guess at the end of the day, the responsibility is ours, outside of our degrees or school, whatever it is, to actually, be curious, like you said, and learn. So yeah, thanks so much for joining us. And I'll let Rory finish off here, but from our side, thanks so much for joining us and for sharing your advice and everything. And yeah, we appreciate that and hope to chat soon. Thanks, bro.
No, that's awesome. Yeah, man. Justin, thank you so much. That was so awesome, and that was so on point. I think those last 2 points especially, and just the one about being curious. I think that's so essential, because again, that curiosity drives you to want to learn, and I think that's the foundation that we've discussed, right? Is learning and then building those habits as we go. So yeah, man, that's pretty, I think you absolutely crushed it there. And yeah, guys, thank you for today. I think it was perfect. I think we touched on a lot of important points.
Thanks so much for having me, guys.
Yeah, no, it's awesome, man. So thank you for being here. Thank you for sharing your knowledge with us. Yeah, man. And I think this is good. I think I wish I had seen this when I was this age, when I was 16. So thank you, guys. That's been awesome.